Good morning, investors. On 05/07/2026, Coca Cola's share surged 3.1% to £61.50, outpacing the Nasdaq, which ticked up 1.2% to 15,200, and the S&P 500, up 0.9%. The beverage giant's dividend yield sits at 3.1%, a modest return that has been growing for 59 straight quarters, cementing its status as a dividend aristocrat. Meanwhile, AT&T trades at £28.30, offering a 7.4% yield, more than double Coca Cola's, and has paid a dividend of £2.28 per share this year. The headline from the Motley Fool on 05/07/2026 even calls AT&T the higher-yield dividend king that could eclipse Coca Cola in the second half of the year. Let's unpack what's really happening today. Coca Cola's recent rally is tied to a 5% earnings bump on Q2 and a fresh marketing campaign that lifted brand equity scores by 12%. The company also announced a $2 billion share buyback, tightening the supply base. In contrast, AT&T's dividend payout surged after the company settled a $1.5 billion litigation debt, freeing up cash for shareholders. AT&T's board approved a 7.5% dividend increase on 01/07/2026, boosting the annual dividend to £2.28. Moreover, analysts now foresee a 3% earnings growth for AT&T in 2027 thanks to its 5G rollout, which could support the high payout. These developments mean that while Coca-Cola is a solid performer, AT&T's yield advantage is widening with every corporate move. For income-focused investors, the difference is stark. A £10,000 investment in Coca-Cola today yields roughly £310 annually, whereas the same amount in AT&T generates about £740. Portfolio managers on 05/07/2026 report a 15% increase in demand for AT&T shares from hedge funds seeking stable cash flow. Meanwhile, the UK-based pension scheme that holds £5 million in Coca-Cola has seen its dividend income grow by £155,000 over the past year, but the scheme's board is now evaluating a split ratio shift to AT&T to capture the higher yield. The market volatility that has plagued tech stocks this year has made the defensive nature of AT&T's dividend even more attractive to risk-averse investors. On a macro level, the divergence between Coca-Cola and AT&T is influencing sector rotation patterns. The consumer staples sector, where Coca-Cola sits, has gained 4.2% in July, while the communication services sector, home to AT&T, has risen 5.8%. Market sentiment indices show a 0.7% rise in the MSCI World Dividend Index after the AT&T announcement. Additionally, the UK FTSE 100, which includes Coca-Cola, increased 0.9%, but the rise was largely driven by a 3.5% jump in the VWRL index, where AT&T is a significant holding. The high dividend yield of AT&T is also attracting foreign institutional investors, increasing capital inflows and adding upward pressure on the stock price. Looking ahead, Coca-Cola's trajectory remains positive. Analysts project a 3.5% earnings growth in 2027, driven by premium pricing and a 2% increase in global volume. The company plans a $1 billion investment in sustainable packaging, which could open new revenue streams. However, the 3.1% yield may become less competitive if the market's risk premium falls. The upcoming earnings call on 15/07/2026 will likely confirm the buyback's impact on EPS and might provide a fresh dividend outlook. Investors who have held Coca-Cola for the long term should expect steady, but modest jam growth. AT&T's near-term outlook is promising. The 5G infrastructure rollout is on track to deliver a 4% revenue lift in 2028, and the company is negotiating a $3 billion partnership with a European telecoms firm, potentially adding a 2% bandwidth revenue stream. Analysts anticipate a 7.5% yield to remain sustainable if AT&T maintains a 1.5% payout ratio. The company's debt is high at $170 billion, but the cash flow coverage ratio stands at 4.2, giving a cushion for dividend payments. While the share price may experience volatility, the dividend yield positions AT&T as an attractive buy for those seeking income and long-term equity upside. In summary, Coca Cola is outperforming the Nasdaq and S&P 500 today, but AT&T's higher yield and growth prospects make it a compelling alternative for the second half of 2026. If you're prioritizing income, a £10,000 allocation to AT&T could double your dividend return compared to Coca Cola. If you value stable growth and brand longevity, Coca Cola remains a solid choice. Ultimately, the decision hinges on your risk tolerance and investment horizon. Keep an eye on the upcoming earnings releases and dividend announcements. They will be the key indicators for your next move.